The broadcast is now starting. All attendees are in listen-only mode.
Assalamu alaikum to all of you, and welcome to the day 5 and the final day for ACCA Practice to Pass session. So can you hear my voice? Please write yes in the chat box if you can hear my voice. I hope you all are fine, and I'm expecting a very positive response of this Practice to Pass session. Which question you want, Fahad Munib? Day 3 practice, day 3 answers. Okay. Answers of practice day 3 will be shared by tonight on the WhatsApp group, so don't worry about it. And even I have shared in the handout section, you can see my handouts. I have shared day 4 as well. Okay. So I gave you a question with the name play, and that's the requirement to prepare the asset side of this company. So is it done? So do you want me to share the answers directly, or should I solve it? So the students are demanding to solve the questions. Okay. So let's start the question. So that's the question. On 1st March 2004, whenever you do a consolidation question, always make your data. So the date of acquisition is 1st March 2004. Player bought 80% of station. So the group has acquired 80% shares. So NCI will get 20% shares. Paying 1,80,000 cash on the date and agreed to pay further 1.2. So 1,80,000, pay further 1.21 per share on 1st March 2006, means after 2 years. So the cost of the investment will be partly in cash, which is 1,80,000, and the partly this amount is in deferred consideration. So we take the present value of the deferred consideration, which is 180. Sorry, it should be need to select the ratio and then again. The payment will be 1.21 into 60,000 into 80%, because we have bought 80% shares of 60,000. So the amount of the payment should be what will be the amount of the payment in future value terms? 58080. And when you go and calculate the present value of this 1 plus 0.10 raised to the power minus 2. So the payment will be made after 2 years. So it should be that is 48,000. So first you need to check whether the cost of investment is recorded or not. The investment is recorded at 2,80,030,000. And only the cash consideration has been recorded. So that's a very important point that you need to see, that out of 2,30,000, 1,80,000 is the value of the subsidiary. So the remaining value of 70,000 will be some other investments. That other investment could be the power of associate, or it could be the investment of IFRS 9. Please guide how to calculate the deferred consideration formula cell. In formula cell, calculating the deferred consideration is very easy. First of all, we need to open an Excel sheet. Yes. Here you can see the deferred consideration. The amount will be calculated as 1.21 into 60,000 into 80%. That's 580. That's the future value. And the present value will be calculated as by taking this amount into 1 plus 0.10 raised to the power. That's the power sign. It's on number 6. So shift 6 will be the power sign. Minus 2. The amount will be 48,000. It's very simple to solve in formula 7. So why we are not taking 180,000 at deferred? 1,80,000 is paying by the company immediately. At the time they have acquired the company, they are paying 1,80,000 immediately. But the share, the cash consideration with reference to the shares or some of the part of the payment is deferred on 1st March 2006. So which is after 2 years. Okay. Deferred consideration. It's better to write the full name. Consideration. So what I have done, I'm just repeating the figures again. Total number of shares which the company has is 60,000. You can see on the balance sheet there are 60,000 shares of the subsidiary company. for each share. So the total payment will be 58040. That is the future value. So we need to calculate the present value of this deferred consideration. The present value will be based on the future value into bracket open 1 plus 0.10 bracket close raised to the power minus 2. This amount will be 48,000. So I hope it's clear now. It's better not to use the observations, but should we adjust for the cash on SFP? No, you don't need to adjust because it's already recorded here. So the I think it's wrong. The remaining part is 50,000 exactly. So now we have almost done with the first paragraph. Now these are the notes that we have. This one is after the acquisition. This part is related to the date of acquisition. On first March 2004, Play transferred an item of the plant to station for 30,000. Its carrying amount is 18,000. So you can see there is a gain on transferring a plant from 18,000 to 30,000. So you cannot recognize a gain within the group. So if the Play has transferred, means parent company has transferred its plant with a carrying amount of 80,000 to subsidiary company for 30,000. So definitely parent company has recognized a gain of 12,000 in income statement. So that gain should also be reversed. And therefore, you need to do its related depreciation as well. Now, the Play group value the non-controlling interest at the fair value, and it's 55,000. Impairment loss is 4,000. Station has earned 24,000 in the year. And Play acquired 80% station, 6% loan. That is the information related to other investments of the parent company, including the Play's receivables 10,000 due from a station. Station has sent a check of 4,000, so there's a concept of the cash in transit. So let's start solving this question. So first you need to calculate the cost of the investment. So we have already calculated the cost of investment. The cash part is 1,80,000 and the deferred consideration part is 48,000. Accounting entry is cost of investment debit, deferred consideration credit. So as the reporting date is 31st December. So you need to take deferred consideration, unwinding of discount for this deferred consideration, but the accounting entry will be proportionated. So the entry will be retained earnings debit, deferred consideration credit for the unwinding of discount, which is 48,000 into 10%, 4,800 into 9 upon 12. So 10 upon 12. Please calculate the amount. $48,000 into 10% into 10 upon 12. that is 10 upon 12. So amount will be 4,000. Wonderful. Thank you so much. Then NCA acquisition was given in the question, which will be 55,000. So what will be the total cost of investment? By adding all these figures, 283,000. Less. We take the fair value of net assets in order to calculate the goodwill. So you need to add only 4 to 5 items: share capital, share premium, revaluation reserve, retained earnings. Now the share capital of the company is 60,000. That's the first point. That is 60,000. Share premium is 5,000. Next step is to add 5,000 here. Then we have revaluation. There is no revaluation that was done on the date of the acquisition. Now talking about the retained earnings. We have been given 1,48,000 retained earnings at the end. And you need to calculate the retained earnings on 1st March. 1st March means you need to calculate the retained earnings 10 months before the reporting date. So the current year's profit is 24,000. So the profit for this 10 months period is 24,000 into 10 upon 12. Can you do the calculation? It's 20,000. So in the post-acquisition period, actually company has earned a profit of 20,000. So what will be the profit of the company at the date of acquisition? By deducting this 20,000 figure, they will get the amount of 1,28,000. So at the date of the acquisition, company has retained earnings of 1,28,000. But we will not make any changes in SFP in finding retained earnings at acquisition. I didn't get your question. Can you repeat your question? Which amount will be treated as retained earnings at the reporting date? Okay. When we talk about the retained earnings at the reporting date, 1,48,000 is the retained earnings at the reporting date. But the retained earnings at acquisition right now in this question is 1,48,000. So 1,28,000. And then you need to make an adjustment for this part of the question as well, because it was occurred at the date of acquisition. So they have booked a profit of 12,000. So that profit should be adjusted from here. So now what will be the net assets? Can you do the calculation? It's 1,81,000. 1,81,000. And the goodwill figure will be 57,000. And sorry, the impairment loss is 4,000. The goodwill after the impairment will be 53,000. Okay. So any question? Yeah, fair value adjustment. You can use this 12,000. I think there are students who want me to show the fair valuation adjustments. This is not a fair valuation adjustment, but you can write, that's not a problem. The goodwill is 283 minus 181. It's not 57 in fact. Someone has done the calculation error, I think. It's is there any URP? Yeah, there is an URP 102,000. That's a goodwill, and there is an impairment of 4,000. So goodwill at reporting will be 98,000. That's fine. So do you want do you people wanted to ask anything about this 98,000 goodwill? Okay, that's fine. Non-current assets. This will be treated as a non-current asset SFPS. So only profit and loss item will be a proportion item. Yes. Okay. One of the students want me to explain goodwill at reporting. 31st December. The retained earnings at the reporting date is 1,48,000. And in this whole year, from January to December, company has earned a profit of 28,000. Is it 28? 24,000. So if we acquired the company at the start of the period, we simply deduct 24,000 from 148,000, and the figure will be 1,24,000, returning that acquisition. That will be simple case. But they have acquired the company on 1st March. So you need to deduct 10 months profit in order to calculate the retaining at 1st March. So what we have done, we are just deducting the 10 months profit, which is 20,000. So when we deduct 20,000 from here, we got the value of retained earnings at acquisition, which is 1,28,000. Two one three. 213, my son, is the total amount of these three figures. 2,13,000 is the sum of the whole equity. These are the totals. Then we had 2%. As in a scenario, we had loss in BF. BF means when we had to apportion it. Yeah, we can have a loss. That's not a problem. Profit is given in here. Profit is given in note number 5. Now let's talk about the gain. Parent company has transferred a plant to subsidiary company with the carrying amount of 18,000 to 30,000 to the subsidiary. So actually, in the retained earnings of the parent company, they have booked a profit of 12,000. So there is a 12,000 profit in the books of the retained earnings. Similarly, there is a profit of 12,000 in non-current assets. Okay, so there's the case of 12,000 non-current asset. So when you reduce this amount and this amount, so accounting entry for this case will be retained earnings of the parent debit by 12,000 and non-current asset will be credited by 12,000. So this part should go in the books of subsidiary. This part will go in the books of the parent company. So in the subsidiary company, net assets means capital or equity. So we are actually calculating the equity of the subsidiary company. So if we credit the non-current asset, that means net asset is decreasing. When the net asset decrease, it will impact on the equity as well. So actually, I'm adjusting the 12,000 because it affects the net assets of the company at the date of acquisition. Now, this is the most important phase that you need to calculate the goodwill. Now, the next step is very simple. Going towards the balance sheet, mostly students write property here. I'm suggesting you to write the full property, plant and equipment. So the property, plant and equipment will be 2,75,000 plus 2,30,000 minus there is a gain of 12,000 plus. So when there is a gain on the non-current asset, you need to adjust the depreciation of that portion please. Can you hear my voice? I think my voice is not clear to this. It's clear. Okay. So can you please calculate the amount? 12,000 divided by 5 into 10 upon 12 will be 2,000 amount. Okay, that's wonderful. 2,000. So now what I have done, I took the value of the parent company's non-current asset, then subsidiary company, then that's the profit that we have earned, which will be considered as unrealized profit, and that's the reversal of depreciation. So the total amount will be 4,95,000. Then you need to report the goodwill figure, which is 98,000. Wonderful. Now what about the investments? Parent company has acquired 80% of subsidiary. Now here is the case. Parent company has invested in subsidiary company the value of 1,80,000. In the books of subsidiary company, there is a loan of 50,000, out of which parent company has invested 80% of this loan. So 40,000 of this loan will be related to the parent company, and the remaining will be other investments. That is 10,000. So other investments should be measured at the fair value. Intercompany investment and loan should be cancelled out with each other, and we got the value of 10,000 here. And this portion will be used for the calculation of the goodwill. So that's the breakup of the investment of parent company. Is it clear? So when we are preparing the balance sheet, we need to report the other investments. We do not have any note related to other investments. So therefore, it should be reported here directly. So now we have completed our part of non-current assets. Moving towards the current assets. The first thing we need to take is the inventory or stock. Inventory figure in parent subsidiary company is 30 plus 35. We never proportionated assets or liabilities, so you simply need to add these figures irrespective of the date of acquisition. Minus, you need to work on for the unrealized profit. So there is a note number 1. Inventory of the plain goods purchased for cash from the station, means subsidiary company sold goods to the parent company. $18,000 with the cost plus 20%. So first you need to calculate the unrealized profit. So 18,000 cost plus 20% means the sale value will be 120, and the profit amount will be 18,000 divided by 20 into 120 multiplied by 20, it will be 3,000. So as the subsidiary company has sold goods to the parent, The accounting entry should be retained earnings debit and inventories credit and NCI debit. So 3,000 will be allocated between the group and NCI at 80% and 20%. So it will be 2,400 and 600. So when you're preparing the balance sheet, the inventories figure should be deducted with 3,000. So the amount should be 62,000. So right now we are doing the asset side of the question. So I request you, all of you guys, to solve this question again on the constructive response workspace. But when we do the equity side today, we will work on the constructive response workspace. So usually people don't know how to use the tools of the constructive response workspace. So we will do the practice on CRQ workspace as well. Now talking about the receivables, we'll be having receivables of 40,000 for the parent and exactly 40,000 for the subsidiary. Is there any adjustment related to the receivables? Yes, we do have. It says parent company receivables is 10,000, which does not match with the subsidiary company's payable. So here I can do an adjustment for you. Parent and subsidiary. Parent company trade receivables is reporting at 10,000, which should be equivalent to the trade payables of subsidiary company. But they have paid a check of 4,000. So their amount will be measured at 6,000. So this cash is in transit. So what will be the treatment of the cash in transit? We assume that the cash has been received. So cash debit and receivables credit by 4,000. So this should be deducted from here first, 4,000. And then we got the value of 6,000, which is exactly equivalent to subsidiaries payable. So these two figures should be cancelled with each other. So what we really need to do is to deduct 4,000 first and then 6,000. So the amount should be 70,000 for this figure. Finally, we have cash. $5,000 plus 3,000 plus 4,000. It will be 12,000. So these are the total assets of the company. I hope it's clear to all of you. So the total figure will be 7,47,000 in total for all the assets. So how many who have calculated this correct figure? When you were doing practice at home? It's okay, but definitely when I am solving this part of the question, Definitely it clears some of your doubts. Now, the students who want me to clear the investments part as well. Parent and subsidiary. When you see the investment part in the books of the parent, it shows it is 2,30,000. In the first paragraph, it tells you that out of this 2,30,000, 1,80,000 payment was made to acquire the shares of subsidiary company. So this part is related to the subsidiary company. So the remaining investment that we have is 50,000. We can assume that this could be an associate company. It could be other investments, or it could be an intercompany transaction between the parent and subsidiary. So when we go and read the note guides us. When you see note number, yeah, this one. When you go and see notes, just reading all the note points. Okay. When you see and read this part of the loan, it says that Play acquired 80% of the station's 6% loan notes. So parent company has also invested in subsidiaries loan notes, which is having a value of 50,000. So out of this 50,000, 80% of the loan has been provided by the parent company. So the loan of the subsidiary company is reported at 50,000, and 80% of the loan is provided by the parent company. So parent company, when we take 80% of this 50%, 50,000, we got the value of 40,000. So it shows that out of this total loan of 50,000, 40,000 was invested by the parent company. So from this 50,000, 40,000 is the investment of the parent company in the loan account. So this is actually an intercompany loan. So the treatment for this is that we normally cancel out these transactions because we never accept intercompany transaction between the parent and subsidiary in consolidation. So the loan of the subsidiary is now reported at 10,000, and the remaining investment of parent company is 10,000, which has not yet been identified. So as there is no indication in the question whether this investment was made in the associate company or any other information, so it should be reported according to the provisions of IFRS 9 at fair value. And as there is no changes in the fair value, so we have just reported it at 10,000. So these are the investment breakup. So I'm guiding you how to attempt this part. Whenever you are attempting reading the question, always see from this paragraph that which part of the investment is recorded and which part has not yet been recorded. So it clearly says that deferred consideration is not recorded, but the cash consideration is recorded by the company. So when we deduct the cash consideration, there must be, if there is something remains, then it means that it could be an associate investment, it could be an intercompany transaction, or it could be a investment of IFRS 9, that is financial instruments. And note will clarify that whether it belongs to associate or intercompany or financial instruments. We had not recorded the deferred consideration. We do record. We have recorded deferred consideration. That's why we took these figures in the calculation of the goodwill. So we have recorded the deferred consideration. You can see the, but examiner has not yet recorded the deferred consideration. So this is our part to record this transaction. So this figure is used for the calculation of the goodwill. Yes, the interest cost of this loan should also be reversed from the income statement. Yes, we do record the contingent considerations at the fair value. So now we have done with the assets side, and now we are working right now on our back to the slides. So in the last session we had discussed about this NCA acquisition. So now I'm giving you this part of the question in which you are required to prepare. No need to prepare the balance sheet right now. Now talking about the fair valuation adjustment, there could be IFRS 3 says that whenever parent company acquires subsidiary company, all the assets and the liabilities of the subsidiary should be measured at a fair value. So there could be a fair valuation adjustment in property, plant and equipment, which could be upward or downward revaluation. There could be a fair valuation adjustment in intangible assets. There could be fair valuation adjustment in inventories. There could be a fair valuation adjustment in contingent liability. There could be a fair valuation adjustment of deferred tax. That's it. So if the company has not yet recognized deferred tax asset or deferred tax liability of the subsidiary, it will also be incorporated at the date of acquisition, if it is related to the date of acquisition. So if there is a deferred tax asset, the fair value of that asset will increase. If there is a deferred tax liability, the fair value of that asset will decrease. With the reference to the contingent liabilities, IS 37 says that all the possible contingent liability should be disclosed. That's the requirement of IS 37. All possible contingent liability should be disclosed. But for the purpose of consolidation, you need to make the provisions of all the contingent liabilities. And definitely, as the liability increases, the fair value of that asset will go down. For inventories, there might be an upward or downward adjustments. Now, internally, IS 38. If you remember IS 38, we have discussed this point that you cannot recognize the internally generated intangible assets. So that's the basic requirement for the IS 38. But when you are doing the consolidation, all internally generated intangible assets must be recognized. So when you are doing the practice from the exam kit, there could be an adjustment of internally generated brands, internally generated customer list, or any other type of intangible assets which are normally not allowed under the scope of IS 38. Talking about only the subsidiary company. Right now I'm talking about the subsidiary company. It has nothing to do with the parent company. That's only applicable for the subsidiary company. So whenever there is an upward revaluation for the property, plant and equipment, there will be an excess depreciation treatment that you need to make. The upward revaluations will be added in the PPE, but excess depreciation should be deducted. While calculating the depreciation or any item related to the income statement, you need to see the time period. The time period is very important. If from the date of acquisition till today, the reporting date, the time period is 10 months. So any income statement item should be a portion, which should be a finance cost. It could be a depreciation. It could be any other income. All income statement related items should be a portion. Similarly, if there is a downward revaluation, there might be a reversal. There should be a reversal of depreciation. Contingent liability point again. Contingent liabilities are disclosed according to IAS 37 when the chances of making the payment is possible. But for the purpose of consolidation, we always make the provision and record this contingent liability as a provision for the purpose of consolidation. So in these questions, you are required to calculate the fair valuation adjustments and the excess depreciation or reversal of depreciation. Company's year end is 31st December 2013. URP is also deducted from the NCI's profit, yes, only when the subsidiary company sold goods to the parent company. But if the parent has earned the profit, there will be no adjustment in NCI. If the question says that there is a reversal of depreciation will occur only when there is a gain on the transfers or when there is a downward revaluation. Then you will find a reversal of depreciation. So please read this question and reply your answers. Yes, is it done? The first thing is there is a revaluation in the land. The accounting entry should be land debit 2 million and revaluation reserve credit 2 million. These all items will be affected at the date of acquisition. An item of the plant had a fair value of 6 million in excess of its carrying amount. The plant had a remaining life of 2 years. So accounting entry will be plant debit 6 million and revaluation reserve credit 6 million. So the depreciation will be 6 million divided by 2 years, 3 million, and from October, November, December, there will be 3 months depreciation, which should be 750. Wonderful. Similarly, practice with the value of the 5 million on spares goods trading relationship. Now, trading relationship with the customers are these type of assets are not allowed to record on the face of balance sheet and the IAS 38. But for the purpose of consolidation, we can recognize this. So there will be a gain of 5 million. The customer and this relationship will last for 5 years. So 5 divided by 5 will be 1 million into 3 by 12. So it will be 250, 0.25. That's fine. So I hope it's clear now. So there's a question for you guys. Please attempt this part. This is one of the toughest question according to the examiner's report. On 1st 2008, paper company acquired 75% shares of stone company, ordinary share capital. The fair value of the net assets of the stone company at the rate of acquisition were equal to the carrying amount with the exception of a liability. Now remember this point, it's a liability which had a carrying amount of 20,000 below its fair value. So the liability fair value has gone down by 20,000. So there will be an increase in the net assets, 20,000. So when there is an increase in the net asset, then there will be a decrease in goodwill, 20,000. The answer will be D. After deducting the depreciation, we will show the amount on net assets at the acquisition. No, depreciation will be charged on the normally after the post acquisition period. So depreciation is normally charged after the acquisition. So we only need to adjust the gains and losses which occurred at the date of acquisition. So depreciation will be charged on the later dates. That therefore it should be reported or adjusted in the retained earnings and NCI. Like suppose companies is having I think we have done a mistake. Let's solve it again. Again, assuming the fair value of the company is 80,000 and the carrying amount is 60,000. So if the carrying amount is 60,000 and the fair value is 80,000, so according to IFRS 3, this liability should be reported at this 80,000 value. So you need to increase the liability amount by 20,000. So the net assets will go down actually, and the goodwill will go up. So we have done a mistake. The answer is C. If say the profit to the parent, then we will write 15,000. I didn't get you. And say 5,000. This is a fair valuation adjustment for liability. So next, this is usually the format that we use for the calculations of net assets at acquisition and at reporting date. Share capital, share capital, share premium, share premium. These two figures will remain the same at your level. Retained earnings at acquisition and reporting will be different. Other reserves, if it is given to you, fair valuation adjustments at acquisition and at reporting date. Unrealized profit and impairment loss. Unrealized profit will be adjusted only when the subsidiary is sold to the parent company. Then if there is an excess depreciation or the reversal of depreciation, it will be adjusted. So this is called the fair value of net assets at acquisition. Just for the explanation purpose, I am referring it with the letter C. And this is my net assets at reporting date. Just for information, I am referring it with the letter 2. So how we can calculate the NCI at acquisition, NCI at the reporting date. NCI at reporting will be calculated at NCI at acquisition. This is the value that we have already utilized in goodwill, plus the post-acquisition profit. Post-acquisition profit means net assets at reporting minus net assets at acquisition into NCI percentage. That is the format for the NCI. NCI could be calculated at the fair value or proportionate approaches. So we have two methods through which you can use. You can calculate the fair value and the proportionate approach. I'm going back and just to give you a basic review for how to calculate. Like the cost of investment, assuming is 1 lakh in both the cases. In one case, the NCI will be measured at the fair value. Less fair value of net assets. Assuming this value is 60,000 and this is parent has acquired 80% shares. Assuming it's 15,000. Now this is how we calculate the goodwill using the fair value approach. Cost of investment, NCI will be calculated based on the fair value. If the fair value was not given in the question, I have taught you that you can calculate it by multiplying number of shares with the share price of the subsidiary company. So the share price of the subsidiary company is actually used for the calculation of NCI. That is called fair value approach. So it will be 55,000 for the goodwill. That is the fair value approach. Now, if the similar situation and if you are required to calculate the NCI at proportionate method, same fair value net asset, same cost of investment, but NCI will be 20% of this amount. That is called proportionate approach. So when you take the 20% of 60,000, it will be 12,000. So in this situation, the goodwill will be 52,000. So this is a case like usually examiner asks for the fair value approach, but in some cases, examiner might ask you to calculate the goodwill on proportionate approach. NCI reporting will be reported on the face of balance sheet. The answer that you have calculated here will be reported at a balance sheet directly. Goodwill impairment will also be deducted, yes, but it has nothing to do with the calculation. Goodwill will be deducted in both the cases. But I'm just telling you how to calculate the goodwill on proportionate basis and the fair value basis. Yes. Yes. Now talking about the revaluation reserve. If there is a revaluation reserve of the parent company, then it could be reported in the face of the balance sheet. Subsidiary company revaluation related to the date of the acquisition will be reported in goodwill, but only the post acquisition subsidiary into group share. H share means group share. And then this will be reported in the face of the balance sheet. So sometimes examiner might ask you to calculate the consolidated revaluation reserves. So parent company's revaluation reserve will be reported totally on the balance sheet, but for the subsidiary company, only the revaluation that was done after the year end. So let's solve this question. All of you are required to solve this question, in which you are required to calculate the NCI, non-controlling interest, at the reporting date. Please solve it. When there is a revaluation at the date of acquisition, that will be what will be the treatment. Revaluation at the date of acquisition of the subsidiary company will be the part of the goodwill that will be included in the fair value of net assets at acquisition. Please do this question. So the right answer, first you need to know about the NCI acquisition. This will be 1100. That's given here. At the rate of the fair value of the married company's net assets were equal to their carrying amount with the exception of A building which had a fair value of 1.5 million above its carrying amount. So 1500 divided by 30 will be the exit depreciation. So the amount will be 50 for the whole year. Date of acquisition to reporting date, yes, 1 year is completed already. So you need to take exit depreciation here, which should be 50 into NCI share is 30%, 15. During the year, company sold goods to Roni. Merrick sold goods. Parent company sold goods. Sorry, subsidiary. Sold goods realizing annualized profit of 5,50,000. So that will be the URP. 5,50,000. And we will take 30% of this 5,50,000. Can you calculate the amount? 550 into 30%. That will be 1,65,000. The next area is the profit. The profit for the year is 3,200, 3,200 into 30%. The share of the profit of NCI is 30%. So we will take 30% of 3,200. So can you calculate the figure? 3,200 into 30%. 960. So by adding these figures, we got the value of 1,880. So the answer is D. Is it clear? So you should be expert in the calculation of NCI and retained earnings. That is a key part of the consolidated balance sheet. No, because the revaluation was done at the date of the acquisition. So all types of revaluation related to the date of acquisition will be incorporated in the goodwill. Now, there are students who always are concerned about how to calculate the retained earnings, and the retained answer of the most of the student does not match with the total answer. So here you have got the format for the retained earnings. If you follow this format, believe me, your answer will be 98% correct for all the questions. Or you will get 98% marks at least in all the questions of consolidation. So just giving you a quick review, holding companies retained earnings, parent companies full retained earnings will be reported here. Subsidiary companies post acquisition, net assets are reporting minus net asset acquisition into holding percentage. Share of associate profit post acquisition, it's impairment loss. Unrealized profit if the holding company has sold the goods. And the percentage will be applied only when the subsidiary sold the goods to the parent. There could be an unrealized profit for the fixed assets, impairment losses, percentage will be applied on the impairment loss only when there is a full fair value approach. In the proportionate approach, full amount of the impairment loss should be deducted. Negative goodwill will be recognized as an income. Unwinding of deferred consideration should be deducted from here. Changes in the contingent consideration can be added or deducted. Any other gains and losses of the parent company and acquisition costs will be deducted from here. So this is the final figure. If you follow this format of the retained earnings, your answer will be exactly the same. Acquisition cost means the cost of acquiring a subsidiary company. So there might be a legal cost when you acquire the shares in the subsidiary company. It could be some professional cost. Yes. So now let's see have this question for the retained earnings. Again, it was assumed to be one of the most difficult questions from the examiner's report. Yeah, day 5 material will be available. Yes. You need to, because we prepare the income statement and balance sheet and the consolidation separately. If the negative goodwill is added in the retained earnings, it will also be added in the P&L. If the share of associate profit is added in the P&L, it will also be added in the retained earnings. Kindly show the previous slide. That's the previous slide. You have 1 minute to catch slide. Day 5 will be updated after the break, because right now I'm just going to finish this topic, consolidation. Then we'll move on towards the topic ratios. Analyzed profit on the fixed asset means the profit which has been earned by the parent or the subsidiary by selling a non-current asset. Like when we are solving the question PlayStation, there is a gain of 12,000 on the transfer of the plant. That's the analyzed profit on fixed asset. Now please solve this part of the question. Again, I wanted to recommend you guys, if there are students who have not yet joined our WhatsApp group, kindly do join the group, because today is the last day of this webinar. We'll be in touch from tomorrow on the WhatsApp group only, and you have the option to message me, or you can call me, or you can send me the email as well. I'm sharing my email address with you guys. That's HAMMAD. If you wanted to send me any answer of yours for checking purpose, you can email me. There is a day-wise plan that I have shared with all of you guys that you need to follow. And the second thing is, from tomorrow, I will share the mock exams with you. You need to follow all the mock exams according to the plan. So the key to the success is the plan study. So if you follow all the study plan of mine, you will definitely got passed with a very good marks. Now let's start the question. Tata Company acquired 80% of the issued share capital of Sono Company on 1st May 2001, when the balance sheet of the Sono Company's retained earnings were 5,20,000. On 15 November 2008, Sono made 2,40,000 sale of the goods to Tata, and on which Sonome has made a markup of 20%. Petter company subsequently sold one quarter of these goods to the external parties prior to at 31st December. The retained earnings of the Petter company was 4 million. So in order to calculate the retained earnings, first you need to know the retained earnings of the parent company, which is 4 million. Subsidiary company retained earnings will be taken as the post-acquisition profit. So the post-acquisition profit will be, okay, it's a loss. There is a loss because at the date of acquisition it was 520. No, it's not a loss. It's 3,400. Okay, 3,400 minus 520 into 80%. Can you please calculate the answer? 6280. Okay. You need to report the amount in thousands. So this figure should be 4,000. Okay. Now in this situation, Patter and on 15 November, Sono made a sale of 2,40,000. 2,40,000 the amount of the sales, on which there will be a profit of 120 multiplied by 20. Please, can you calculate the profit figure here? 240 divided by 120 multiplied by 20. Is it 40 or 30? 40. And the Petter subsequently sold one quarter of these goods. So there will be 3/4 left. 3/4 means 75% left in the warehouse. So the analyzed profit for the will be 30. So as subsidiary company has sold, so we need to take the 80% figure here. So it's 24. Is it whether this figure is correct? 3,400 minus 520 into 80%. 2304. Thank you so much, Deepa. So the final answer will be time portion. Don't we need to make the timer portion? No, you cannot. You will not do the timer portion because of the fact that the retained earning was given to you at the date of acquisition and at the reporting date. Yeah, as the subsidiary company is selling, then it should be deducted, but with the percentage. Why we are deducting the acquisition retaining from the reporting date? Because we need to calculate the post-acquisition profit. Because only the post-acquisition profit of the subsidiary will be reported on the consolidated balance sheet. How we get 24? 240 is the value. 240 is the value of the sales, in which the markup is 20%. So I take 20 upon 120, we got the value of 40. As 1/3 of the stock was sold, sorry, or as 1/4 of the stock, means 25% of the stock was sold outside the group, only 75% of the stock is remained. So the unrealized profit figure will be 30. As subsidiary company has sold the goods, so 80% and 20% will be distributed between the group's retained earning and NCI. So 24 will go in the retained earnings of the parent subsidiary company. The group's retained earning, and 6 will be the adjustment in NCI. Is it done? $30,000 to 80% is 24,000. Yes, you're correct. Suppose retain is loss. No, it's not a loss. The answer is 6280. 6280. So let's move on. Here is another question for you guys. Why not a loss? It is saying there is the retained earnings at the reporting date is 5.4, and at the date of acquisition, the examiner has actually confused you. So this figure is 5,20,000. This figure is 3.4 million. It's 3,400,000. So when you calculate this figure, it actually increases from 5,20,000 to 3,400,000. So it is actually a huge profit. To give a minute to my question, Madhya Firdaus wanted to ask something about. Please, can you share your question again? Unrealized profit will be 30. Yeah, 30 is the total amount of the profit, and it will be shared between the group and NCI, 80% and 20%. Madhya, can you repeat your question? Where is your question? Just it will always be applied, the percentage, but in the examination kit, normally the examiner, what the examiner do in the Kaplan kit, that they adjust the unrealized profit figure in the net assets. So if you apply the percentage of net assets or the individual items individually, that's totally same. S2P sale does not be included in the consolidated reserve. Yes, it should be included in the consolidated reserve if subsidiary is selling goods to the parent or the parent is selling goods to the subsidiary, but the percentage will be applied only when the subsidiary is selling goods. Yeah, you have to apply it. Examiner is also applying it, but you will not be getting to, I think you are not getting the scenario, or you are not getting the point, but believe me, they will apply always the percentage when the subsidiary sold goods to the parent. let me give you this point. Like subsidiary companies post acquisition profit D into C into holding percentage. So we are applying group percentage on the post acquisition profit. What the examiner do in the exam pit, they include the analyzed profit in this figure. So what they are doing, they are including this figure, analyzed profit, into the post acquisition profit and then applying the percentage. And what I am telling you is to take the profit separately and analyze profit separately. Both should be applied with the percentage. That's the same thing if I add these two figures and multiply the percentage here. The answer will be the same. So here is a question for you guys. I want all of you to please solve it and give your answers. You have 1 minute for this. Now consolidated retained earnings. The parent company's retained earnings is 116. For the subsidiary company, you need to take the post-acquisition profit. At the reporting date, it's 30. And at the date of acquisition, it will be 20. So by taking 70% of this figure, you got the value of 7 here. And goodwill is 25. 20% of the goodwill is written off. So 25 million into 20% is 5. So 5 into 70% will be 3.5. So that will be the value of the, so it will be 119.5. Very good. It will be 119.5. Post retained earnings of the subsidiary company is, now you can see the previously the retained earnings at reporting at acquisition is 40 and now it's 50. So there is an increase in the profit of 10, out of which 75% will be the parent share. No. You can see here by adding these two figures, we got the value of 50. So net assets at the reporting date is 50. And it is saying that at acquisition it was 40. So the 20 will remain the same. So definitely there will be a profit of 20. That's why the fair value of net asset was 40 at the date of acquisition and now it's 50. So there will be a change of 10 in the retained earnings. Or you can just take the difference between 50 and 40. The answer will be the same. One more question for you guys, in which you are required to calculate the total equity. So when it talks about the equity, you need to add the share capital as well. It's not asking for the retained earnings only. So you need to add the share capital and the retained earnings as well. So what will be the answer for this question? I think it's B. Is it clear, or do you want me to solve it? Solve. Okay, let me solve it. Always remember this point, that whenever you are reporting consolidated balance sheet or preparing consolidated balance sheet, we only report parent company share capital, because the subsidiary company share capital will go in the calculation of goodwill. So we never take subsidiary company share capital on the face of the balance sheet. Only the parent company's share capital. Now the retained earnings figure is parent company's full amount plus subsidiary company's post acquisition. 150 minus date of acquisition was 90 into 75%. So by simply adding this amount, we got option B. Now that's the new thing in consolidation, that is associate, IS 28. Previously, I have given the basic introduction of the associate, means an entity on which we have got the significant influence. Significant influence means power to participate, which could be assumed when we have 20% or more shares. Associate will never be consolidated. Do remember this point. We never do the consolidation for the associate company. That means associate companies, asset, liability, capital, nothing will be reported on the consolidated balance sheet. Only you need to report the equity, apply the equity accounting for this, and this will be the total accounting for the associate company. Previous MCQ final answer is B. Okay. So there will be just one line accounting for this associate company, in which the investment will initially be recorded at cost and subsequent adjustment will be made for the post acquisition profit into associate percentage minus impairment loss minus dividend receipt minus unrealized profit, as we have discussed in the last session, when the associate company purchased the goods. Associate buys the goods from subsidiary, or so there the accounting entry will be in the investment in associate. So just remember this formula. Here we have a question for you guys. All of you are required to calculate the investment in associate company, that is stream company. You have 1 minute to solve this question. Okay, is it done? Now let's solve this question. Now initially investment in associate. Initially invested 1,200,000 by acquiring 30% shares on 1st August. Remember this point, you have acquired the shares on 1st August. The profit for the year is 7,50,000. But the post-acquisition profit will be from August to December. August, September, October, November, December, January, February, March. 8 months in which we have got 30% shares. On 31st March, Stream had 300,000 goods in its inventory, which it had bought from the Johnson. So the subsidiary company has acquired from the parent company inventory having a value of 3 lakh. Markup was 30%, so divided by 120 multiplied by 20. What will be the amount for this? Stream has not paid any dividend on the assumption that the Stream is an associate. That's 50,000 into associate percentage. That will be 15. So I think the right answer is A. Yes. So you have to be very careful when you are solving the MCQs. The single mistake can give you the wrong answer. It's clear now? Okay, now I'm giving you just 5 minutes, not 5 minutes, 2 minutes to complete the equity and the liability portion of this part of the question. PlayStation, all of you are required to prepare the liability and the equity part of this question. You have 2 minutes for this. Yes, all of you are required to complete this question. We have covered the asset side. Now we are working towards equity and the liability side. So please start working on it. Okay, so without wasting our time, let's solve the question. I'm solving the equity and the liability section. Bold, little bit. Equity shares. Only the parent company share capital should be reported, which is 1 lakh. So if you do not have any working for this, you can only write this 1 lakh because you do not have any working for this. Then we'll be having a retained earnings. Then always give a gap of at least one row when you are reporting NCI. Then non-current liability. And finally, we have a current liability. To make it prominent, we have bold all these headings. Now, moving on towards the current liability, we'll be having 75 plus 45. 75,000 liability plus 45,000 liability minus there is one intercompany transaction which was 6,000. So that's the whole liability. In the non-current liability, there is 6% loan notes, in which part of the loan will be intercompany transaction, so it should be cancelled. So only 10,000 can be reported. We also need to report the deferred consideration, which was 48,000 plus 2,000 unwinding of discount, or you can also give the reference from your working, that is 48,000 plus 2,000 is the unwinding of discount. Suppose if you have done the working here, unwinding is into 10% into 0.1 multiply by for how many months? From March to December, 10 upon 12. That's 4,000. Unwinding of discount will be 4,000 from here by just simply adding the figures. That will be 52,000. We do not have share premium, I think, in this question. Oh, sorry, we also have a share premium account as well. So we can insert a raw. Okay, remember this point. Whenever you are doing the examination, you cannot insert a raw in this. So if you have done mistake like what that I have done, so what all you can do is to select all these figures and then Control X, and after the next you will paste the data, so it will be transferred towards the next row. Share premium will be reported as 20,000. So only the retained earnings and NCI is left over. Retained and NCI acquisition is, I think, 55,000. NCI acquisition, yes, 55,000. Retained earnings of the parent company should be taken first. It is 385,000. Now you can do all the workings directly here, plus bracket 20,000, 24,000 the current year's profit, and which you have earned 10 months profit in the post acquisition, in which my share is 80%, 0.8 minus unwinding of discount, which is 4,000, minus note number 1 is related to the unrealized profit. How much unrealized profit we have calculated? Can you guide me the profit figure? Can you guide me about the profit figure for the unrealized profit? Amount of unrealized profit was 3,000. Yes, 3,000 is the unrealized profit. Yes, 3,000. Who sold the goods? Play includes subsidy sold. So this amount should be adjusted with into 0.8. 0.8. Okay, again there is a depreciation. Impact of that is the reversal of depreciation. Depreciation figure was 12,000 divided by 5 into 10 upon 12. What was the depreciation figure? $12,000 divided by 5 multiplied by 10 divided by 12. So the amount was 2,000. So reversal of depreciation should be added 2,000 into 0.8. That's note 2. Note 3 has done already. Note 4 is about the impairment. Impairment of 4,000 into 0.8. Note number 5 is done. Everything is done. Yes, that's my retained earnings. Now I need to adjust the NCI as well. NCI will be adjusted for all the post-acquisition profits. That will be 20,000 into 0.2 minus 4,000 impairment loss into 0.2. Minus unrealized profit of 3,000 into 0.2 plus the reversal of depreciation of the reversal of depreciation figure was 2,000. 0.2. So whatever amount was distributed to the group with 80%, the 20% of that will also be shared with NCI. So when you total all these figures, your equity and liability should be balanced with the total amount of assets. Is it balanced now? Yeah, it's fine to do these long workings on the Excel. Now this is how examiner checks an answer. When you click on this cell, there will be no workings. An examiner knew that there is no working the share capital. Then you will get 0.5 marks for this. Then share premium, no workings available, that's fine. Now when he clicks on this retained earnings, there will be a detailed working. That's the parent company share, okay. That's the post acquisition profit into 80%, fine. Minus 4,000 for the analyzed profit, unwinding. 3,000 is analyzed profit, 2,000 the reversal of depreciation, and 4,000 is finally the impairment loss. Everything is perfect. You will get 3 marks for this. What about NCI? When he clicks on this, there will be a detailed working from the NCI. Remember this point, if you punch just 58,000 directly without any reference and without anything, even if you write this like working to, go to and see working to, examiner will give you 0 marks. So don't punch for the values that you have calculated. Either it could be a cell reference or there must be a detailed working that should be shown here. So working is perfect. You will get 2 marks from there. Yes. Have you done the adjustment? Yes, you have done the adjustment. You will get 1 marks. You have done the adjustment. Yes, 1 marks, 2 marks, 1 mark. And have you do the adjustment for the current liability? That's 1 mark. So this is how examiner will give you the marks. So there is no marks for the totality. The total might be wrong. The individual figures must be correct. Won't give the unwinding of profit for NCI. No, unwinding of discount is actually the adjustment in the books of the parent company. Yeah, we should take a break now. Student was asking for the break. So I think the balance sheet is quite clear to all of you guys. So just after the break, we will start working on the income statement. It's better to draw a line here so that examiner while checking can understand that this is your, on the left hand side you have done all the proper presentations, and on the right hand side you have done all the workings. Practice on Excel. Yes, I'm giving you some questions to work on the Excel. I'm just telling you the names of the question that you need to do. That's the examination kit. The first question that you need to do for the practice purpose is wait for 1 minute. Just opening the file. Now, the first question is Dargent that you need to practice. Dargent. First question is Dargent that you need to do the practice. The second question is yes, Laurel. Lau, Laurel. Just writing the name of the questions here. One is Dargent. Balance sheet for the income statement is Laurel. Then the next question is Bicom for the income statement. Polestar. So these are the 4 questions that you need to send to me for the practice purpose. So right now we are taking a break of 5 minutes and we will start after the break. Yeah, all these questions are from Kaplan. That was the working for the goodwill. Yes, consolidation and single entity, both are important, but from my point of view, for this session, final account is more important than the consolidation, because one question is definitely from the ratio side, and the second question will be sometimes examiner might ask you for the consolidation, or sometimes it could be from the final accounts. Okay, welcome back after the break. So today we have to cover the topic consolidation, and Alhamdulillah, we have covered the balance sheet area. That's just the format for the income statement. I want all of you guys to just review this format so that we can start the topic ratios. We can start the topic ratios. So when we do the consolidation for the income statement, the first thing that you should know is that you need to know that whether the time period is 12 months or more than 12 months. So if the time period is 12 months or more, then you need to just simply add the parent and subsidiary company's data minus intercompany sales. But if the time period is less than 12 months, then you need to proportionate subsidiary companies' results based on the controlling period. So whenever you are preparing income statement for the consolidation, always remember this point: the date of acquisition is very important. Then cost of goods sold, holding plus subsidiary minus intercompany sales plus unrealized profit plus excess depreciation minus reversal of depreciation. All the depreciation related adjustments should be considered in the cost of goods sold. Then simply you need to add this operating expenses, other income. So the basic format for this income statement is you need to add the similar items and you need to cancel all intercompany transactions. So that's the basic theme for consolidated income statement. Then one more thing is very important that the students normally miss is the finance cost should include the unwinding of discount. Any intercompany related finance cost should be deducted from here. Changes in the contingent consideration, negative goodwill, share of associate profit, these all items should be included in the income statement before the finance cost. And there is a gain or loss on the investment measured at the fair value through P&L. Then you will find the profit, and this profit, after this profit, we will report the other comprehensive income, and this profit has to be split between the group and an NCI. So how we can distribute the profit between the group and NCI? Here is a format for calculating the NCI. So if you follow this format, you will be having the value of the NCI, and the balancing figure will always be the share of the parent company. So this is the format. Income statement is comparatively very easy to understand and very easy to handle as compared to the balance sheet. Now there is a concept of the gain or loss on disposal. The one concept is in the books of the parent, and the other concept is in the books of the group accounts. With reference to the parent, when there is a gain on when there is a disposal of subsidiary during the year, you need to take the cash received less investment sold. This formula is quite simple, and this is how we calculate the gain or loss on disposal. Sometimes the examiner might ask you to calculate the gain or loss on disposal with respect to the parent company, or it could be with respect to the group of companies. So the formula will be cash received plus investment retained less net assets at disposal plus goodwill, which is left over till the disposal date, plus NCI at disposal. So by adding, this is a separate working. By adding these figures, we got the final answer, and here we can find the gain or loss on disposal. So gain or loss on disposal is a compulsory part which usually examiner ask in even the ratio related questions. So some of the students are very much worried about the ratios topic. Believe me, ratio is a very easy to understand and a simple topic. Just you only need to follow some of the guidelines that I will be sharing with you. The second thing is, um, I have shared a 3 hours video lecture with you guys in which there will be a topic of IS 33, EPS and ratios. They all are fully covered. So this is the basic format for the PNL. This is the breakup of NCI. And this is formula for the gains and losses on disposal. So in the examination, you will be given this data directly. You only need to put the values in this format and you will get the answers. So these all, I'm just giving you these questions for your assignment purpose. There are a few MCQs related to the consolidated income statement. So if you follow the formats, I think you will be in a position to attempt the questions. So first of all, let's attempt one question for the past papers. Let's attempt one question for the calculation of this gain, loss, and disposal. Then we'll be switching towards the topic. Now this paper, there are some fireworks going on in my area. I don't know why the people are so much happy in getting married. Okay, so that's the question for you guys. Now the requirement is calculate the gain or loss on disposal. We should have been shown in the consolidated profit and loss of the Perkins group. So you need to calculate the group gain or loss on disposal. So here you will be having the data from which you can calculate the gain or loss on disposal. So be quick and calculate this value. So now here the question says on 1st September 2007, Perkins sold all of its shares in Swenson. So when you are selling all of its shares, then it means the cash received is having a value, but fair value of investment sold is 0. And you sold the subsidy for 28.64. So that is 28.64. At this date, the Swenson had a net assets of 26.1. So at the date of disposal, you will be having a net assets less, let's net assets at disposal. That is 26.1 million. Then Perkins originally acquired 80% of the Swenson for 19.2 million, when the Swenson had a net assets of 19.8 million. And the goodwill was measured at 4.9. So can we calculate the goodwill right now? The cost of the investment is 19.2 plus the fair value of NCI is 4.9 less fair value of net assets is 19.8. So the value of the goodwill is 4.3. We add the value of the goodwill here, which will be 4.3 less NCI figure. NCI at the disposal was not given to us, so you need to calculate the NCI disposal. NCI acquisition was 4.9 million, but in the post-acquisition period, the net assets of the subsidiary has grown to 26.1 million from 19.8, in which NCI has got 20% shares. So this will be the post-acquisition profit for the NCI, 26.1 minus 19.8 minus 19.8 into 20% share, that will be 1.26. So by adding these two figures, 4.9 plus 1.26, you will get the value of 6.16. So when you deduct 6.16 from this figure, you will get the value of 26.1 plus 4.3 minus 6.16. So the value will be 24.24. So the gain or loss on goodwill should be, it will be 4.4. That is the gain or loss on disposal. Yes, the data will always give you to you, right? Now, Now you can see the similar type of questions, that is for the March-June attempt. Calculate the gain or loss on disposal of Samba, which will be recorded in the individual financial statement of Pill Lookup and the consolidated financial statements. So again, when you read these notes, you will be given the data for the calculation of gains and losses. How to get the, it will always be given to you. But if it is not given to you, you only need to take, you need to add the post-acquisition profit. Okay. So that's the day 5 handout. Let's start with the topic. Let's read the first people are, some of the students are waiting for this topic desperately. That is ratios. Now, you need to understand this. What is ratios all about? You have studied the ratio topic previously in the initial exams of ACCA as well, and most of the people know about the formula through which we calculate the ratios. So where's the problem? The problem is actually lies in the communication skills. So when we go for the interpretation, there are students who got confused at how to interpret and how to give the analysis of the question. So here value of the investment sold will be given, yes. So what the examiners give you about the ratios topic, examiners feedback is the students will get less marks because of the limited knowledge of the ratios. People forget to say, for example, they forgot the formula of ROC. You should know that the formula for the ROC with the return on capital employed, PBIT upon capital employed. And one of the formula that we use for the ROC will be asset turnover ratio into net profit ratio. So these are the two formulas that we use for the calculation of ROC. So the limit knowledge of the ratios calculation. So you should remember each and every formula for the ratios that is examinable. So examiner is not expecting at this level that you will not be having a knowledge of the formula for the ratios. Always calculate the ratio using this formula, but when you are going to interpret the ROC, you will need to see if the ROC is increasing or decreasing. The responsibility will be on the asset turnover and the net profit ratio. Then the students does not usually not linking the appraisal with the scenario. Limited understanding over the accounting information represents lack of commercial awareness, inability to come to the conclusion, and the most important part for the students in Asian countries and in African countries are the English. Usually they don't understand that how to write the answer, and they will not be able to in fact translate what they wanted to say in the English language. That's one of the problem that students are facing. So the most important part is the communication skill. I must say the writing skills. So if you have got the good writing skill, then ratio is just peanut for you. So now what examiner wants exactly from you. For all the cases, examiner will give you usually 2 years for the comparison, 2020 and 2019. Either it is a case of single company or it is a case of consolidation. In both the cases, you will be having 2 years in which you need to calculate the ratios. Sometimes even examiner do the calculation by their own. So all you need to do is to just give the interpretations. So you only need to identify at this point. Suppose if the revenue of the business is 1 lakh in the last year and it's 2 lakh in the current year. So you need to understand this point. There are some hints in the every ratio question that limits the comparison, that distort the overall comparison. Like suppose if my company is making masks, so my 2019 revenue is 1 lakh, and in 2020, if it has grown to 2 million, so there is a substantial increase in the revenue. So definitely there will be a substantial increase in the profitability. But the main point that you need to highlight at this point, the point that distorts the comparison is that these 2 years are not comparable, because in 2020 we have got the COVID-19 all around the world. So the demand of the mask has grown artificially. So the revenue, if there is an increase in the revenue, that does not only mean that the company has performed well. It was actually because this factor that there is a COVID. And when you are going to compare this 2021 with 2021, so when you are going to compare 2020 results with the 2021 result, and if assuming there will be no COVID in 2021, there will be a substantial decline in the revenue of the business who are producing the mask. So if the revenue of that company goes down by 1 million, you cannot say that your performance is poor at this level, because the previous year was inflated because of the fact that there is a COVID all around the world. So these are some hints. These types of hints will be given to you in the examination that distorts the overall comparison. Like, again, I'm giving you a question, an example. Suppose in 2020, 2019, there is a, when I'm talking about the group right now. So there is a parent company and it has got 3 subsidiaries, S1, S2, and S3. And at the start of 2020, parent has sold one of its subsidiary. So in this in this year, we'll be having only 2 subsidiaries. So if you compare the group having 4 members with the group having 3 members, your comparison will definitely be affected. So whatever areas is affected, you need to incorporate into your interpretation that this decline was due to the disposal of one of the subsidiaries. So there are one of events that affects the comparison. Similarly, if there is an acquisition, suppose previously I have got only 2 subsidiaries, S1 and S2. And now in the group we have got P1, S1, S2, and S3. And if you are comparing the revenue of 3 companies with the revenue of 4 companies, so definitely you will find that there is a substantial increase in the revenue. So if the company is saying that you are performing well, so your answer is totally wrong, because you need to know this fact that there is an additional company that was acquired during the year. So when you acquire a particular company, there will be an addition during the year, and that will boost your revenue, your expenses, your profitability. But you should highlight in your answer that this boost was due to the acquisition of this subsidiary. Now, there are some areas related to the consolidation that you need to understand. Suppose if the parent company has acquired a subsidiary company the financial year starts from January to December. So if you have acquired on 1st July, so what we do in the consolidation. So when we are preparing the consolidation, the sales will be parent company full sales, but for the subsidiary company, we apportion the sales figure of the subsidiary company. Because we do the income statement consolidation only for the controlling period. So if we have acquired a subsidiary on 1st July, so our controlling period will be based on 6 months only. So we will be doing the consolidation for the 6 months only. So there are ratios that is related to income statement and balance sheet. But when we do the balance sheet, we never do the proportionate consolidation in the balance sheet. So the balance sheet figures will be reported full amounts, but the income statement figures are reported at 6 months. So if you are taking, for example, debtors turnover. So debtors turnover is having a formula of debtors divided by sales multiplied by 365 if you wanted to calculate the debtors turnover in days. So the debtors that you have calculated will be based on the full values, but the sales that you took and the denominator will be for the proportionate period, that is for the 6 months. So this is again a problem when you acquire or dispose of a subsidiary during the year. So these are the two areas that the examiner usually asks for consolidation. Now with respect to single company, when we talk about the single company, there are certain facts that distort your comparison. Like if in 2019 and in comparison to 2002, if there is a one-off gain, like we have sold a non-current asset during the year, so there will be a huge gain that will go in the income statement. So in the year when you sold the non-current asset, there will be a gain huge in the income statement, and as well as there is a substantial increase in the liquidity position. So if you compare this with the previous year, and you are saying that we have earned a very substantial amount of the profit as compared to the previous year, so that's not the fact. So what you need to do, you need to just deduct this profit because of the disposal. It's a one-time profit or one-off profit. So first deduct this profit and calculate the revised profit without this gain, and then compare this profit with the previous year profit rather than the overall profit reported in the income statement. So you need to remove the impact of one-off items for the comparison with the previous years. So there could be any other type of hint that the examiner might give you in the examination. So this part is related to the appraisal is not linked to the scenario. The students just ignore the one-off or different hints given in the examination. So that's the reason the students are just giving the general comment that if the gross profit ratio is increasing, that means there is a increase in the sales price or there might be reduction in the cost. So these are the general comments that the examiner don't want it to hear. The examiner wanted to know that you should know how to incorporate the scenarios, because remember this point, when we do the comparison, there will always be some areas that distort the comparison. So there is nothing that can be comparable in this world. Like even if you compare the things, the inflation will distort your comparison. Inflation, the previous year's price index is different as compared to the current year. or even if there is a change in the management style, that will definitely affect your performance. If there is an additional acquisition of non-current assets or disposal of non-current assets, then definitely it will affect your performance. Similarly, if you are comparing the two companies, company A and B, and you wanted to know which one is better, so you need to see this point that you first have to identify what are the areas that distort the comparison. Like if the A company is following the cost model for IS 16 and B company is following the revaluation model, and the prices are increasing over the period. So what will be the impact of this particular difference? So if the company is doing revaluation, the properties of that asset will be higher than the value of the properties of company A. So its assets will be understated, its profits will be overstated, its assets will be reported at higher amount, and definitely the profit will be affected. Similarly, when you do the calculation for that type of ratio in which there is a capital employed in the denominator, so if there is an increase in the net assets, one of the formula for the capital employed is total assets minus current liability. So if there is an increase in the non-current asset, that definitely it will affect the denominator. If the denominator is overstated because of the revaluation, your ratio will always be shown the understated figure. So we use ROC and asset turnover. So these are the two ratios in which we will be having capital employed in the denominator. So when there is an upward revaluation, these ratios will always be understated. And similarly, when there is a downward revaluation during the year, these ratios will be overstated. So these are the points that affects the comparison. So if you highlight the hints in the examination question that distorts or that affects the comparison, and you just include the impact of those hints in your answers, examiner will give you full marks. Believe me. So that's one of the problem that students do at this level, that they did not incorporate. Then talking about the English, what type of mistake that the students usually do at this level? Suppose if the gross profit ratio is, if the gross profit ratio has increased from 20% to 21%, and student is writing that there is a substantial increase in the profitability over the period, or the profit has grown dramatically, or you can say that the profit has increased substantially. So that's the point. Examiners say that, don't you know what's the meaning of substantial? There is no substantial improvement, in fact. Or if you can say the operating profit ratio or the net profit ratio has gone from 19.5% to 19%. So now the students are writing that the profitability of the business is deteriorated drastically. So these are the words that you should be avoid if there is a little change, either on the upward or downward side. So these type of change words can only be used when you see a massive increase or a massive decline. So these are the formulas for the ratios that you can see on the screen with some basic comments. And these are the attached MCQs. As we are running already short of time, that's why I'm just giving you these slides. You can download this data from the handout section. So these are the basic formulas that you need to learn and some comments, basic comments. So only if you include the hints with these comments, and all you need to do is to just read this article. That's one of the handout that I have compiled. It's already mentioned in the handout section. That's the analysis area. It will tell you how to write the analysis of cash flows. Then it will tell you about the ratios. For each ratio, what are the things that you need to know and what are the areas that you need to write. These are 8 pages handouts. If you just read this handout 3 to 4 times, then you will feel comfortable in topic ratios. So this handout has 3 areas. The first one is related to the consolidation. It will tell you about how to interpret the consolidated financial statements, single company, and the cash flow statement. So this is my analysis based handout. You just read this article and my handout for 3 to 4 times, and then you can go and attempt any question. One more thing that you need to worry about for ratios practice, I'm recommending you to do the practice from the past papers. So for the ratios question, you should start from this year, that is December 2020. Select this paper, try to solve this question of the ratio analysis, then go in the downward direction from September, December, and then March, June, then September 19, December 19, March 19, and then go till March, June 17. Believe me, if you solve all these questions, you will be perfect in the topic ratios. Okay, I have shared one of the video lecture on the group related to IAS 33 EPS and the ratios as well. If you are still not satisfied with the ratio topic, you can just go and see my video. It's available on the group. And tomorrow morning, I will share the mock examination. It's my highly recommendation to all of you guys to please follow my special plan. If you follow my special plan, that will tell you on a daily basis what you need to do. Just follow the plan, do maximum question that you can do from the Kaplan kit related to section A and B. But with reference to section C, I have given you 4 questions for final account, 4 questions for the consolidation, and I'm giving you 3 to 4 questions from the ratios which you need to do from the past papers. Kaplan is enough for section A and B. No, I will share the mock on a daily basis. And if any of you wanted to know, because there are a lot of students who are confused about how to give the answers on the CRQ workspace. So my recommendation for all those students is to do the practice on CRQ workspace in these days. And if you wanted me to check your answer, you have to solve the question on the Excel and email me on my email address. For final account, you need to do 4 questions for the practice. That is triage, Haverford, Vernon, and Duggan. So thank you so much for attending these sessions, and I think that sessions are valuable for you guys. Please give your valuable feedback to the ACCA so that ACCA can conduct this type of session for the future students. And I will be available for all of you guys till the examination date. You can ask anything from me, or even if you want, you can take my time for the meeting. We can have a meeting on the Zoom as well. If you wanted to discuss something or some concepts with me, you can call me, and I will be available till the examination date. And please give your valuable feedback to the ACCA. And I hope this session will give you some boost up in the confidence, and that's definitely will improve some of your concepts about the IFRSs. So thank you so much for the time. We'll be discussing further on the WhatsApp group. Please stay connected. Thank you so much. Do take care of yourself and remember me in your prayers. Allah Hafiz.